Hey, what's up, dividend investors? Mike here for Dividend Stocks Rock. I hope you're doing well today. Today, we're going to look at the top 6 most popular dividend stocks at DSR. So I created Dividend Stocks Rock in 2013. We will celebrate our 12th anniversary this year. And throughout the years, DSR Pro members has the ability to build their portfolio online, get their ratings, forecast their dividend payment in the future, and of course, receive a quarterly report telling them what exactly happened in the recent earnings. So they don't have to waste times to track earnings, to look at financial statements and understand everything, all of this. We do the hard work for them so they can just spend a couple of hours a month to manage their portfolio, and then investing becomes super simple. So I thought of sharing with you the top 3 US and top 3 Canadian stocks with the bull and the bear case for each of them. Of course, they're not buy or sell recommendation. They are just very popular at DSR. But since we count over 4,000 seasoned investors on the platform, it probably tells you a thing or two about the stock that you should put on your buy list and do some more due diligence. So let's get started with the third most popular stock on the US side, Visa, that was last year number 4, jumped at number 3, and as you can see on the dividend triangle graph, this company is just amazing. So constant revenue growth, constant earnings growth, and of course constant dividend growth. So when you have a perfect dividend triangle like this, you're not really surprised to see the stock price going up pretty much every single year. So the bull case for Visa, well, first and foremost, their business model is just amazing. It's like a toll road. They charge a fee on each transaction, and they're just making a lot of money on each of those. They do not carry the debt on the credit card. They leave that to the bank that issued a card, and they're just there to facilitate the transfer of money. So they just make a lot of money like this, and they evolve in a duopoly situation where Visa and MasterCard pretty much control the entire market. They are present across the world, and they have one of the fastest and more reliable payment network. Last but not the least, because they charge a fee on every single transaction, that makes it a very stable source of recurring revenue, which of course lead to more revenue growth, more earnings growth, and more dividend growth. Nothing is perfect in this world, and there is also a bear case for Visa. So the first thing is, you probably watched the news in 2024. The Department of Justice, DOJ, is running after Visa for their practice around their debit cards. It's going to create some drama. I don't know if what's going to be the end up of that lawsuit, but overall, it's definitely going to create a source of distraction. It could lead to potentially other kind of problems. So you have to know that you are dealing with this when you buy Visa. Another thing that is a source of concern is the fact that merchants are getting tired of this duopoly. They are forced to pay those fees, and sometimes with credit card with points, those could add up to over 1% in fee for the merchant. We saw Amazon trying to cancel all Visa transaction in the UK a couple of years ago. Didn't last long, but you can see that there's some kinds of an upsetting feelings that are coming out from merchant that could potentially push innovation elsewhere. So maybe a new company will come with a new way of transferring money with a solid payment network. Definitely merchant will be open to that. And of course, if you are entering into Visa or MasterCard at this stage, well, keep in mind that it is also linked to the consumer discretionary sector, in a sense where if there is a recession, consumers are going to spend less, and of course, it means less revenue and less earnings for Visa. Number 2 most popular stock at Dividend Stocks Rock, Apple, with over 800 members that has this company on its portfolio, and probably 800 members that are smiling when you look at the stock price graph that keeps on going up all the time. However, it's a little bit more difficult in terms of the analysis of the dividend triangle. You can see that Apple is going through product innovation cycles. So from 2016 to 2018, barely no revenue growth. 2019 to 2021, same story. And then 22 to 25, we're seeing about the same story. That is also reflects on the earnings. So this one is really going from one plateau to another. It's not constant as Visa. On the bull case, we do have an amazing product ecosystem. Every single Apple product talks to each other. They connect to each other seamlessly, and a lot of Apple consumers become Apple fans for that reason. Because they sell so many iPhones every single year, they have become a huge cash flow making machine. Actually, one of the biggest challenge that Apple could has is to look at their bank account and look at how they can benefit, they can create value from that cash to shareholders because they're generating literally too much cash flow. Finally, the next thing is because they have this strong base business model with the iPhone and various services products besides it now, they are able to wait and see what is going to be the next trend. They don't have to be the first or the second one in the market. They can enter into an existing market, such as the smart Apple Watch that they have created. They were definitely not the first one, but they came with a great product trying to sell it at the pricing premium, and it has worked well. On the bear case, well, let's get started with the obvious, a steep valuation. So the company is priced for a lot of growth, and right now it is not delivering. Another challenge that Apple will have is how many new cameras they can put in onto the iPhone or any other technology improvement that they can create to kind of invite you to buy the iPhone 17, 18, and 20, right? So it's going to be tough to get out of that product cycle with the iPhone. So Apple is trying different things with its cash flow. As of late, they have invested massively in the rise of artificial intelligence with not that great results so far. So this could also end up into destroying a lot of value and not being able to keep up with competitors. Finally, the product innovation cycle will always be a source of concern because whenever they launch a new project and it's a success, well, then the company is making a lot of money. But in the meantime, we're all sitting in the waiting room and we're just hoping that Apple will deliver a new baby so it can generate more growth. Now, the most popular stock year over year at Dividend Stocks Rock is Microsoft. Almost 1,000 members as it in their portfolio, and once again this one shows a nearly perfect dividend triangle. You can see that the stock price be a little bit more volatile, but the revenue and the earnings are increasing steadily. Most of the time we have high single digit to double digit dividend growth, so this is a company that is built for today and for the future. On the bull case, well, of course we have the massive investment in OpenAI with ChatGPT. So the rise of artificial intelligence, Microsoft is definitely in that run and it's definitely a leader. So there are multiple ways they can benefit from that investment. They can integrate it into a lot of their products as well. So definitely there's a lot of room for growth and make a lot of money for Microsoft. The other one, well, they have been writing this case for about 10 years now. It's the cloud services. So they're second behind Amazon for public cloud services. They have developed a great expertise, and Azure, that is their platform, is still growing at about a 30% growth year over year rate, which is sometimes disappointing for analysts, but when I look 30% growth for such a large business, I'm still smiling. On a smaller scale, they also have a great presence in the gaming industry with the recent acquisition about 2 years ago of Activision Blizzard. So they have created a great ecosystem with the Xbox and a great suite of video games that is creating recurring revenues. There is also this strong bond with corporate America, making it a very sticky business. So companies are buying for licenses for Office 365, Dynamics 365, and Windows, and they are paying this such as a utility bill. So it's going to create a lot of recurring revenue. So it's a great base for Microsoft. Similar business model, as you can see, versus Apple versus Microsoft, where they have a strong base business model and then they use that cash flow to generate more projects and create more wealth for shareholders. Again, this one is facing a lot of competition. So one of like the biggest bear case here is the fierce competition. When you invest into AI, well, you're facing giants such as Amazon or Google. So you're not the first one and the only one in that playground, and you can get crushed by competition quite fast. The other thing I would mention on the bear case is obviously the fact that Microsoft is currently priced for perfection. What it means is at this kind of PE ratio, if Microsoft starts to report low single-digit growth, the stock will quickly tumble. So analysts, investors, everyone is expecting from Microsoft to continue to thrive and report high single-digit to double-digit growth every single quarter. So that's a lot of pressure to put on a stock. So before I move on with the top 3 Canadian stocks, you may be thinking, well, Mike, those are not really dividend payers. They have yield that are super low, under 1%. So how come they are so popular at Dividend Stocks Rock? Well, the thing is, we have a different mentality at DSR and we focus on low yield, high dividend growth companies. Actually, you can download the Dividend Income for Life guide that will explain you why we have decided to go with this strategy. We made the comparison between high yield and low yield companies. We also explain why low yield companies outperform greatly the high yield, and actually investing in high-yielding stocks is quite risky, and we explain why in that guide too. We offer you a step-by-step process to build your portfolio using this low-yield, high-dividend growth policy, as well with a retirement example, even for retirees. Even if you need 4 to 5% of your portfolio as a source of income, we show you how you can create it in a different way with a mix of a dividend income, selling shares, and also using a capital reserve to avoid when the market drops. So you can download it at dividendstocksrock/income, or you can use the link in the description below. So now moving on with the third most popular company at Dividend Stocks Rock, went from position number 6 last year to position number 3, Royal Bank, with almost 1,400 members with it in its portfolio. As some banks have struggled in 2024, not to mention BMO and TD, well, Royal Bank is holding the fort steady and keeps on growing. You can see that, yes, there was the COVID event between 2020 and 2021, but besides that, the revenue and the earnings are growing quite steadily, and so is the dividend. On the bull case, well, Royal Bank is the biggest bank in Canada, so they have a dominant presence. They are present across all provinces as well. The other thing that I really like about this one is this diversification. So they are more recession resistant because 50% of the revenue is coming from wealth management, capital markets, and insurance, instead of just doing classic banking activities and being highly reliable on mortgages and commercial loans. Finally, the growth in the capital market in wealth management is also a great way for them to continue to publish high single-digit to double-digit growth moving forward. They also try expansion into the US from time to time. Right now, it seems to be working well, but it's not always what happened in the past. On the bear case, well, even with that diversification, Royal Bank has one of the largest, if it's not the largest, mortgage portfolio. So in other words, if there's a problem with the housing market in Canada, well, Royal Bank is going to take a hit. The other thing is, of course, while the company looks bright and shiny today, you can never underestimate what's going on inside the business. We had a great example with TD and the money laundering lawsuit that they suffered in 2024 with steep penalties, and now they are stuck with a no growth in the US, so they are not able to grow their assets, and there's no time expiration on that, so we don't know when it's going to stop. So they could be put on the penalty box at any time. You have to be careful. And finally, with a very strong presence in Canada, of course, if you are afraid that there's a recession coming, well, Royal Bank will be a victim of that recession, and they will increase their provision for credit losses, which will put additional pressure on earnings for a short period of time. We are getting close to the most popular stock at DSR, which is the most popular across both markets. But in the meantime, we're going to take a look at Fortis. with almost 1,500 members that own this great utility stock. So on the bull case, well, we do have an amazing business model showing over 50 consecutive years of dividend increases. There are only 2 companies in Canada with over 50 years of dividend increase, and Fortis is number 2. Canadian Utilities is number 1. The reason why it has been able to sustain their dividend payment like this, it's due to their business model. So they operate mostly in Canada and in the US, but they have 99% of their assets that are regulated utilities. They use a very simple but great playbook where they spend a lot of money, so they call it CapEx. So you see capital expenditure in billions every year to maintain their power grid, improve it, and create new projects to generate more energy. And then they go see the regulators and they increase their rate. They have been able to do that for many years. They have strong relationship with regulators, and they have been able to create a reliable and constant source of income from this business model. On the bear side, well, it's a utility business, so do not get too much excited. You're not going to have a huge growth story with Fortis. Actually, growth opportunities are quite limited if they just stay within the assets that they have. The better option for growth would be to make acquisitions, which is not always easy with regulators. You can end up paying a steep price, and there are also risks of integration, not to mention the debt that will come with that acquisition. So it's always a risky play, but it is pretty much the only way that they can actually generate more growth. Finally, of course, we have seen this over the past 2 years. Interest charges could have a major impact on earnings. So because it is a capital intensive business and because there's not a lot of growth, the company is also subject to get hurt by interest charges. Overall, they have shown a great expertise to manage this over time, but you never know when the management team will fail. Finally, the most popular company at DSR is Telus with almost 1,700 investors. So you can see those 3 Canadian companies are trading on both on the US and the Canadian side, which increase their chances of being the most popular stock. And for a long time, actually before 2022, Telus seemed to have it all. So they were showing a stable business model, plus some growth, plus the ability to increase their earnings, and they kept increasing their dividend. So the story was perfect, but then everything changed when interest rates started to increase and other problems started to rise. So on the bull case, well, there is still a lot of room to grow on the wireless industry, and Telus is the closest to a pure play on the wireless services compared to Bell and Rogers. There is less penetration for wireless services than in the US in Canada, so that opens the door for a little bit more revenue increases. Fiber internet will also provide a lot of stable recurring revenues because they are well known across Canada. And once you get your cable internet, it's pretty rare that you're going to change every single year. So that will create a good stability there. They also decided to diversify their business model with Telus Healthcare, Telus Agriculture, and Telus International that are expected to become growth vectors. And I know right now it's not exactly what's happening. It's actually a good reason why the stock price is so low. So on the bull case, I would add that with such a low price, there is an interesting opportunity here to grab some shares and hope that the stock will come back. But hope is not an investing strategy, so you need a game plan. For Telus, the game plan is quite simple. Number one, they have to keep improving their cash flow metrics. This is what they did in 24, and this is why I still hold the stock in my portfolio. They show better cash flow from operation, they show a free cash flow covering their dividend, and they show a reduction of their capital expenditure. I'm expecting the same thing in 2025. If not, I will seriously consider getting rid of it. Part of that game plan, of course, is also to have their Telus Healthcare, Agriculture, and International actually generating value. On the bear case, well, there are a lot to say, but let's just summarize it with fierce competition. So yes, there is room to grow in the wireless industry, but when you face Quebecor, Rogers, and Bell at the same time, it's a crowded space with big guys playing. It's cost a lot, so the growth is limited. The other thing is, I just mentioned it, Telus Agriculture, Healthcare, and International, right now, they're not growth vectors. Actually, they are destroying values for shareholders. They're not doing that great, and this is a huge burden for them. Speaking of burden, while interest charges, it has been the talk of the town over the past 2 years. Yes, now interest rates have slowed down a little bit, but whenever those big companies renew debts, they will have to pay a higher price than they got in 2020 and 2021. So even if we still had a little bit of a break as a consumer, Telus will still have to see their interest charges increase for at least a year or two. Finally, while we all know that the immigration policy in Canada has been more restrictive going forward, so it will reduce the growth of the population. And of course, if the population is not growing that fast, well, they will not go for having more mobile phones and wireless services. To end up this video, I would like to highlight the fact that there is also always a good side and a bad side. There's always a bull and a bear case for every single stock. I hope that I've helped you to make some decisions or understand a little bit more the context around those companies. Do not forget to download the Dividend Income for Life guide to understand where we're coming from with our preference for low yield, high dividend growth stocks. So you can download it. There's the link in the description below, dividendstocksrock.com/income. Do not forget to subscribe and like this channel so you do not miss our next video next Thursday. And until then, don't forget to stay invested.